Okay, part 6. Let's carry on. The types of financial products that an FSP can deal with. So, yeah, you would also learn this in RE1 and RE5. FSPs may have various licenses in respect of different product categories. The product category may also have different products falling in the main subcategory. And these are called product subcategories, as we just said on the slides before. So the category descriptions in the FACE Act are as follows. Category 1, let me put it this way. If it is not in all the other categories, it must fall in category 1. So category 1 relates to the financial service provider. It means all persons other than persons referred to in category 2, 2A, 3 and 4 who are authorized to render financial service other than the financial services mentioned in categories 2, 2A, 3 and 4 as set out in the relevant application. So let's look. We've got category 1. We've got category 2. We've got category 2A. Remember, this one has got an A as well. Category 3 and category 4. Oh, my artwork is getting better. So you see this 1, 2, 3, 4, 5. So you see there's 5 categories, but do you see category 5? I don't see it. There is not a category 5, but there's 5 categories. The reason is they split up category here. They split up category 2 into category 2A as well. That is why there's 5 categories. There's basically 2 category 2s, category 2 and category 2A. All right. So don't fall for that trick if they try to catch you. That's it. They tell you there's a category 5. No, but there's 5 categories, yes. It ends at category 4. So what is category 2? In relation to a financial service provider, means all persons who are authorized as discretionary FSPs as set out in the relevant application. Category 2A, in relation to the financial service provider, means all persons who are authorized as hedge funds FSPs as set out in the relevant application. Category 3, in relation to a financial service provider, means all persons who are authorized as administrative FSPs as set out in the relevant application. And last but not least, category 4, in relation to a financial service provider, means all persons who require licenses as assistant business FSPs. Now you need to know this. There are questions about it, but I've got an easy way for you to remember it. Just remember the sentence, funny dogs hunt animals alone. I will say it again. Funny dogs hunt animals alone. Have a look here. If you didn't hear me properly, here on top I've got it for you. Funny dogs hunt animals alone. Now when you get the categories, I always use this and I remember it. So, and I made the F and the D and the H, the D and the H and the A and the A in red, because if I know my sentence, funny dogs hunt animals alone, what does the F stands for? The F is for category 1. There, for funny, it means financial service provider. You see, the F is for financial service provider. The D in dogs is for category 2. The D stands for discretionary FSP, financial service provider. The H in Hunt, they have got the H in Hunt, stands for hedge funds, financial service providers. The A in animals, if you go to the top there, the A in animals, A for animals, is my administrative FSP. And the last A, the A in alone, the A in alone is for my assistance financial service provider. So I know out of my head, funny dogs hunt animals alone. F in funny is financial service provider, funny dogs. D in dogs is discretionary hunt. H is hedge funds. Funny dogs hunt animals is administrative. Alone is assistance. Now, if you are afraid you're going to get confused between administrative and assistance FSP, just remember in alphabetical order, AD comes before AS, and that is why I circled the AD and the AS. So that's why now the AD, administrative FSP, must come before the AS, assistance FSP. And there you've got it. That is how you know your categories. Very easy. Now let's go more into depth. So if you look at category 1 financial service provider, they are the only FSP who can give advice and or an intermediary service. They can do one or the other or both. All right. When you look at category 2, dogs, discretionary FSPs. Now, a lot of people will ask me, Jaco, what is a discretionary FSP? We are going to look into that. To work in category 2, you need a qualification at a degree level. Not 120 credits, a certificate, or 240 a diploma. You need at the degree level. They only do intermediary services of a discretionary nature, and that is the guys that do your investment managers. They manage the investments. They are doing category 2 discretionary FSPs. They don't give advice. No advice. You see, on the rest of them, no advice. When you look at hedge funds FSPs, also they must have a qualification at a degree level. They only do an intermediary service, and that's your hedge funds, as your guys in JSE, guys that are doing Forex or stocks, etc. They don't give no advice. Why? Because the brokers will give the advice and lead them to a hedge fund FSP who will take the money from the client and just invest it in Forex or stocks or whatever, buy shares on the JSE, etc. The same with the investment managers. All right. When you look at administrative FSP, AD, they must also have a qualification. They work in category 3 at the degree level. They only do an intermediary service, which tells me no advice as well. And that is the guys that are doing the unit trust, your bonds, your shares, method of bulking, and your LISPs, which is your linked investment service providers. All right. LISP, the L stands for linked, the I there stands for investment, the S stands for service, and the P in LISP stands for providers. And last but not least, assistance FSP. They also do only intermediary service, which means no advice. And that is the people doing your funeral policies, maximum up to 30,000 Rand, and your friendly society benefits, your offsetting of claims, processing of claims, payments of fees, or commission in respect of an assistance policy. So I hope you've learned something from this. What are the new financial products? Still category, this is category 1, all your financial products, and you will see category 1 has got 1.1 all the way down to 1.127. So it means it's got 27 subcategories. And crypto assets was recently, now by the end of 2023, added also as a financial product, falling under category 1 and category 2. But under category 1, it's 1.27, subcategory 1.27. And that is all financial products. And you can only give advice on financial products that is there. If it's not in one of those subcategories, it's not a financial product and you cannot give advice on that. Just for interest sake, have a look. Do you see cash there? Is cash a financial product? No, you will not find cash there. So I cannot advise somebody what to do with their cash, because that's not seen as advice. If they ask you, give me advice, must I buy a car cash? Me and you think you advise him, no, don't do it. Rather invest it, blah, blah. But you see, the cash is not a financial product. But if you now tell him to invest, and you'll be looking at investments. Investments is a financial product. Then you can give them advice. But if they just tell you, I've won some cash, I want to buy a car cash, give me some advice, then it's not. 1.4.4, explain the relevant pricing relevant to each product category. The categories of deposit accounts discussed below are discussed broadly. Banks offer various product types within these categories, such as a standard check account aimed at entry-level check account users, opposed to a more exclusive check account aimed at attracting high net worth clients. Various pricing options are available, and the pricing of a product will depend on the option that the client has chosen. If you look at check and transmission or transactional accounts have various pricing options that a client can choose. These accounts do not attract credit interest. And then 1.4.4.1.1, pay-as-you-go use option. This option means that the client only pays for the transactions made on the account. The transaction fees applicable to the account type will be levied from the account monthly. In some instances, depending on the product, the fees are levied immediately, which means the account is debited as soon as the transaction has been processed. Fixed monthly fee option. A monthly fee is levied for a specific number of transactions. Not all transactions are included in the monthly fee option. For example, once-off or specialized fees such as special clearance or overdrawn account fees. If the limit of the number of transactions chosen by the client is exceeded, the client is charged per transaction. And your monthly balance maintained. If a client maintains a specified balance in the account, for example, 10,000 Rand for a full calendar month, specific services will not apply. So then they will give him discount or this or that or whatever. Money market deposit or transactional accounts. The general price of these accounts relates to the transactional fees that could be considerably higher than a basic check account, given that the account attracts interest on credit balances, as well as providing the same transactional ability as a check account. The transactions are usually charged on an ad valorem basis. And you still remember what's ad valorem? Hands up, I want to see. Ah, got a few. I cannot really see. I'm just playing around. Ad valorem. We said there's 1, 2, 3 parts. Does that ring a bell? 3 parts. Ah, Zay. You're clever people. You got it. Ah. Which means that some transactions are charged a base fee, remember? A base fee plus a percentage of the transaction value up to a maximum amount, while others are charged a base fee only. Depending on the bank, some transactions will be free or included as part of the product package. When you look at the savings account, there are various savings account options available to choose from, ranging from a standard savings plan to a contractual savings plan. The pricing depends on the type of savings account selected. Transactional fees applicable to this type of account are cash withdrawal and cash deposit fees, as well as ATM withdrawal and deposit fees. Some banks charge a monthly fee for this type of account. Some banks charge a monthly fee for this type of account. There are also savings accounts that have a transactional functionality, like they are like transmission accounts, but attract interest on credit balances. Transaction fees on these type of account will be charged on an ad valorem basis. Call accounts. Call accounts do not attract specific pricing options. In some cases, an ad valorem fee might be charged on deposits or the withdrawals or the transfers and statements. Fees for special clearances could also be levied on this account, as well as any additional requests for backdated statements. There are no penalty fees on a basic call account because the funds can be accessed immediately. Most banks do not charge for the basic transactions on these type of accounts. The interest earned on this type of account will be lower than that of a notice deposit or a fixed deposit. Why? Because a notice account, you must give notice, also with a fixed deposit. They're fixed, they are longer. So your interest will be higher. The pricing structure of an account includes the interest rate paid on the account, and the bank can price interest rates in such a manner that it includes basic transactional costs. Notice deposit accounts. These accounts do not attract a specific pricing option, and there is no monthly fee payable. Special fees, such as the request for special clearance or backdated statements, could attract a fee. Cash deposits could also attract an applicable cash deposit fee. Penalty fees are payable on these types of accounts, and the pricing differs from a flat fee to a percentage of the withdrawal amount. These accounts do not attract a specific pricing option, and there is no monthly fee payable. Penalty fees are payable on these types of accounts, and the pricing differs from a flat fee to a percentage of the withdrawal amount. Alright, then we look at 1.4.9 fixed deposit accounts. These accounts do not attract pricing options, and there is no monthly fee payable. That sounds beautiful to my ears. But penalty fees are payable on these types of accounts, and the pricing differs from a flat fee to a percentage of the withdrawal amount. That is the catch. All right. 1.4.10, explain the fees relevant to each product category. So let's look at the introduction. The Code of Banking Practice states that banks have to provide details on the following. They have to give the details on charges for basic banking services, the fees, etc., charges for all products and services as requested by the client, charges and fees that are negotiable, charges and fees that are in addition to the basic charges and fees as advertised, and interest rates and calculations. They have to provide these details. Provide the details. Okay. According to the Code of Banking Practice. Clients are informed of the fees and charges that will be levied for various transactions that are usually carried out on a specific product that they have chosen. Fees and charges can be levied at regular intervals, for instance each month. Fees and charges could also be levied at the time a transaction takes place. Transactional accounts such as a transmission, a check account, and money market accounts attract regular fees such as ATM transaction fees or monthly administration fees. These accounts can also attract ad hoc fees, in other words, fees that are not a regular feature of the account. For example, unpaid debit order fees where there were sufficient funds in the account, or where there were insufficient funds in the account. I just wanted to say something that didn't sound right. In other words, the person did not have enough money in the account for the debit orders in the account, or special clearance fees where a special clearance was requested on a check deposit. Call notice and fixed deposits generally do not attract regular fees. A penalty fee would be applicable to notice or fixed deposit account should the client wish to withdraw part or all of the funds before the expiry of the notice period or maturity of the fixed deposit. These fees vary from bank to bank. So if you look at the types of fees and charges, there are numerous types of transactions that can take place on bank accounts. Banks charge a fee for most transactions and services. That is also a way how they make their money. And these fees include VAT. There are many types of fees that banks charge for the various product types, including the following. Over-the-counter fees. As we said, when you see that teller wants a salary, they charge the bank. Or actually the bank, well, they cannot charge the banks pay their salary. But it costs the bank money to have that person there. These are charges for transactions made in the branch, such as when the client deposits cash or makes a withdrawal at the teller's counter. It is cheaper to avail of electronic type banking, and banks encourage clients to use this mechanism rather. The more labor intensive a service, the higher the cost. The more clients that came into a bank to perform basic transactions, the more staff members have to be employed, and the higher the cost of the overall business operations. Specific over-the-counter inquiries, such as balance requests, could also attract a fee. Administration fees. These fees are also known as monthly service fees, and the pricing for each product will differ. This charge is a fee levied over and above any transactional fees on the account and is a once-off monthly payment. A service fee is usually charged based on the nature of the product and the corresponding service provided. Then we look at debit order fees. It is a charge to the client for the processing of a debit order to the client's account, and the pricing of these fees vary from bank to bank. ATM transaction fees. Fees are charged for withdrawals, deposits, balance inquiries, and mini statements, as well as account payments and transfers. The price and fees for transactions always relate to the type of pricing option chosen and the account product. ATM fees are charged at a higher rate when using another bank's ATM. You know, if you don't draw at your bank but you go to another bank, the fees are higher. And then card fees. Clients can be charged an annual card fee depending on the product, as well as a replacement card fee when the card has been lost or stolen. These fees can be negotiated, and in some cases, the charge can be waived. Statement fees. Many banks charge clients for mailing regular statements to them every month, depending on the product type. If the client makes use of the electronic receipt of statements, for example, via email, then there is no charge. Fees are also charged for the request of additional statements. And please note, when a customer has a complaint and statements has to be drawn to resolve the complaint, then there is no charge. Only when there is complaints and you need to draw the statements, there's no charge. Stop payment fees. If the customer requests to stop a debit order, a fee is charged for the cost of processing the request. And then unpaid fees. A fee is charged for a debit order that has to be returned because the client has insufficient funds in the account to cover that amount. So make sure you've got money in your account, because if it's unpaid fees, the banks can charge you for that. And that's the end of part 6. Hope you've learned a lot and that I showed you some nice things with illustrations. And there's my email address again. Best of luck, and I hope to see you in part 7. Cheers.